Okay. All right. Well, let's go ahead and start. Um, Good afternoon, Checkmate crew. Today is Thursday, July 14th. It is just afternoon here in New York. Um, we had a very interesting day yesterday. First thing, let's just get straight into business. So the thing that I want to talk about yesterday first before we start talking about what happened today. So yesterday at the end of the day, okay, it was looking like we were seeing junk bond markets calming down. All right. Yesterday, I think in like the last 2 hours of the day, okay, so about an hour after the 30-year auction, we saw a response in the bond market. Huge amounts of selling in the junk bond market. It was actually, it looked strong in the beginning of the day when when I saw the order flow on HYG. And some of the earlier signs, I thought at first it was going to be an advance day, more advances than declines. Last 2 hours, that's not the case, and I confirmed it with somebody. I know somebody who's got a Bloomberg terminal, and so they gave me a little peek yesterday, last night. I asked to just peek at some junk bond data, and yeah, last 2 hours of the day, huge amounts of selling in junk bonds, and we ended up with a large decline over advances, curling our line down. Okay, so a couple days ago I was suspect of this. I was like, hey, it is going up 4 days in a row, but it's still very weak. Okay, it couldn't really get up higher. Okay, and that's all the only reason why I was hesitant to say that, oh, maybe this rally has some legs. So, and lo and behold, look what happens. We have two decline days, and yesterday was just a big wave of selling in the last 2 hours, curls it down, back to risk off. Okay. And then this morning, we had the bank earnings releases from Morgan Stanley and from JP Morgan. Let's just take a look at that right now. Let's see where they're at. So overall, XLF is down big, and most of it is because of those names. JP Morgan announced earnings lower than expected earnings. All right. It was a slowdown from last year. But again, last year, you have to remember, the reason why they were able to beat on earnings was because they were comparing it to 2020. Okay, so compared to 2020, yeah, there were all these big earnings beats, and that's part of the reason why I think that at least for this second half of the year, we're going to see some earnings guidances lower. Okay, it's not just that, but yesterday I went over the whole list of reasons why. September is also an options award month for lots of CEOs. So it only makes sense to guide lower, to make the stock price lower, so that when they do get awarded those options, they get awarded it at lower strikes. It just sets them up for a low hurdle to jump over. And hey, if you guide lower and you beat it, your stock could go up, and all of a sudden, all those calls or all those options become in the money. All right, it's one of the oldest tricks in the book for CEOs. Okay, they wrote about it even 100 years ago. All right, so there's that. There's also the fact that for the past 6 months, even though growth prospects have been slashed, they've been raising earnings estimates. I think I think in this quarter they're probably going to lower it by an average about 5%. That's what I'm looking for. And I think we're already seeing that in banks. Maybe we see that in the tech names too, in the mega techs, but we'll see. Okay, we'll know more in about 2 or 3 weeks. But JP Morgan also halted their share buybacks, and that really set the stage for selling in JP Morgan. All right. I think their dividend is secure just from their earnings. It looks like their dividend is secure. if that dividend goes, I mean, JP Morgan will have way more pain ahead of it. But I don't think so. I don't think that's going to happen. But again, we shall see. Morgan Stanley also reporting lower than expected earnings. But I guess it wasn't as bad, or at least the market is not taking it as bad. Okay. Actually, how is the 10 and 2 year doing? So sometimes, especially JP Morgan's earnings call can move bond markets. It looks like it's coming back, but we'll see. Okay, and again, I just think earnings estimates are going to get guided lower. If we see a big wave of all these guidances lower, it could set us up for a little bit more volatility this summer. And I think a lot of that volatility will probably come from that. I think the fears over inflation, I think, are. I don't think there's that much fear about inflation anymore, at least for this season. Just because yesterday when the CPI report came out, it was big nothing burger. I mean, everything dropped for like 30 minutes and then it recovered in the morning. All right, junk bonds bids were very, very strong in the morning after the market opened. So I think all that inflation, higher than expected inflation, has been priced in. Now I think we're shifting the pendulum. The story now is changing. Now it's about this recession obsession and earnings. Okay, earnings growth. Are we going to see earnings growth? Or are we going to see earnings contraction? Okay, so I think guidances are going to be a little bit going toward the lower end. I think we're going to see 5% decrease. Again, it's just because the CEO award structure. Also, too, this is a great excuse to do it. I mean, the dollar is high, growth, there's recession fears. Why wouldn't you do this if you were a CEO? It only makes sense, it only makes sense to do it. If you were going to do it, you would do it now, okay? So there's that. So that's kind of the recap of what happened yesterday and into pre-market today, okay? The top thing on everybody's mind is the dollar. Look at that. Dollar's on a rampage. Anything priced in dollars, just taking a hit. Stocks, oil, taking a hit. RBOB, gasoline, also taking a hit. Natural gas is up, though. Okay, natural gas is up. Again, I think this is more because of the export terminal reopening soon, and I think natural gas is just front running that. Actually, I'm curious, how are the grains doing? Grains are up. I don't know if this is weather related or not. I know last week there were fears of a hotter than expected summer. So, and there were some fears that maybe some of those crops, might get burnt up. But we'll see. Okay, we will see. I'll keep an eye on this. Let's look at the wheat. Oops. Wheat down and soy up. Oh, like yesterday we were looking at feeder cattle, how it was rallying. I don't know why it's rallying like this. I don't know what caused this, to be honest. I don't know if it's lower than expected yield. I haven't seen any reason why. We'll see. But again, it looks like inflation expectations is just already kind of priced in. We look at TIP TLT. It broke out yesterday, but then it fell back down. It fell back down to that base area. Today also it tried to pop up a little bit, and now it's coming back down again. Okay. Again, I think for the season, inflation has peaked. Now, again, the CPI report from yesterday. CPI report is, looks back 3 months. Okay. With all these commodity prices coming down, I think the highest reading for the year, or at least for the season, for the next 6 to 9 months, I think it's either going to be this one or the next one. And then we'll probably see the CPI numbers cool, and that will give the Fed an excuse to ease. And actually, that's what the bond market is expecting right now. The bond market is expecting a much more aggressive Fed going into next meeting and for the rest of the year. Okay, now they're pricing in, instead of a 75 basis point increase in the Fed funds rate, now the market is pricing in a 1% Fed funds rate hike. Okay, almost within 24 hours, it went from a low probability of that happening to now it's like, I think, over 80%. And I posted that picture in the Discord earlier today on those chances. Okay. But also, if you look at some of the forward rates, and if you look at some of the future dated later month contracts on Fed funds futures, it is expecting, though, that we will have in 2023 75 to 80 basis point rate reduction in the Fed funds rate after all the hikes this year. So right now the bond market is pricing in a super aggressive Fed for the rest of the year, to the point that the economy contracts, and then they're going to have to start easing and lowering rates in 2023. Again, I keep repeating myself over and over again. This is exactly what happened in the 70s. This is exactly what happened in the 70s, okay? They would raise rates. It went from it went from inflation to recession obsession. The Fed would cave in. They would take their foot off the gas pedal when it comes to tightening, or they would start easing. About a year or so later, inflation would rear its ugly head again. Okay, so I think that's what's going to happen here. Do I think it's going to be a full 10 years like it was in the 70s? No. I think markets move a lot faster now than what they used to. I give it about 5 or 6 years. I think in 2024 it comes back. Inflation will come back. We'll have another commodity cycle, probably mid to late 2023, causing inflation for 2024. At that point, they're going to have to tighten even more, and then monetary policy won't be enough. Then there will need to be a fiscal policy response. Budget deficits are inflationary. However, because of all the high inflation prints this year, they're going to have to raise all those entitlements, cost of living adjustments for Social Security, veterans pay, military pay. All of that will have to go up, because of the CPI going up. So they won't be able to make cuts. What are they going to have to do? They're going to have to raise taxes. Okay, so I think that's going to happen in 2024. Again, that's very similar to what happened in the 70s. It took about 4 or 5 years for that to manifest itself, but I think in this round, it'll manifest a lot quicker. Okay. Again, I'm not trying to predict the future. I'm just trying to anticipate 5 or 6 moves ahead. Okay, just like any chess player would. You don't know exactly what your opponent's going to do, but you think 5 or 6 moves ahead just in case, right? So that's what I'm seeing. All right. In order for, there's a lot of things that are connected to all this too. The dollar, again, that's something that I mentioned. I think, a more sustained rally, you're going to want to see the dollar come down in order to see a more sustained rally. Okay. Actually, if you price the S&P 500 against the euro, we're actually back in the June highs. Okay, so if you take the S&P 500, you divide it by euros, it's already near the June highs. So if the dollar can come down, if the euro dollar pair can go back up to 106 or so, that would mean that I think the S&P 500 could easily shoot up to about 4,100. Okay, if this comes back to 106, all right, if this goes up to 106, I think S&P 500 can go up to about 4,100s. Okay, but again, it's really all dependent on this dollar, and the euro is just bringing up the dollar because of the fears of all those industries being shut down in countries like Germany. Germany is the export powerhouse of the eurozone. And so, in the last 20 years, a higher euro was justifiable because of the current account surplus of Germany. Well, If their industry stays shut down because they're prioritizing natural gas to households, then what happens to that current account surplus? And if it's extended for a period of time, then how can a higher euro be justifiable? And that is what's going on right now. That's the question all traders are asking, and that's why we're seeing this weakness in this pair. Okay, so all eyes on this. Really, I think for risk on assets, if you want a very good indicator for this environment, look at the Euro USD. If you want to just look at just a couple of indicators for yourself, I think you should look at the Euro USD, okay, which means you're also looking at the dollar, all right? And also, if I were you, I would also be looking at the 5-year Treasury bond note, all right? You want this to go a little higher. Okay, this is not the yield. This is the actual 5-year Treasury bond note price. This is the futures price, okay? You can use the futures to gauge price, all right? So you really want this to go up. The reason why you want this to go up is so that the near-term rates come down. When bond prices go up, rates are coming down. Okay, interest rates, yields are coming down as bond prices go up. So if the 5-year goes up, that means the 5-year yield is coming down, which steepens the yield. Okay, it steepens the yield and also lowers rates overall. That would be a big plus for tech, and it would be a plus for bank stocks too. Because not only are you lowering interest rates, so allowing growth to run up more, you're also steepening the yield curve, and that will also cause a relief rally in bank stocks. So those are the three. If you had to just look at 3 things to gauge risk assets, and something that you can easily chart in any brokerage, I would be looking at, again, ZF, which is the 5-year Treasury note, futures. I would also be looking at the Euro USD currency pair, as well as the dollar index. All right. Also look at the junk bonds advanced decline line. But again, that's something that you cannot chart on your own. That's something you're just gonna have to trust me on, and just to visit our Discord and just view it that way. Okay. And I also put it on the videos too. All right. I also put it on the videos here. All right. So those 3 things that I just mentioned, you can track yourself. This, I'll track for you. Okay. So those are the things that you really want to be looking at for any risk asset, whether it's stocks, whether it's, crypto assets, whatever it is. That's your risk on, risk off signals. Okay. That you really want to look at for this season. Okay. Let's look at some of our other data points here. This is our MOVE index. This is the bond volatility index. Still high, still going up, not coming down. All right. This is growth over value, still in its uptrend. If we see a bear market rally, I'm telling you guys, go long on growth. This is telling us growth. Okay. Actually, I also think small caps is pretty strong. I think this last Russell rebalance, there's a lot of stronger companies that entered it. So may not be a bad idea if you want to play this bear market rally, or if you want to play for a mini bull market, which I think is going to happen in 2023. We're going to have a mini bull market year. I would seriously consider small cap growth, actually. Okay. And I might do something like that. I might do like a mix. I might do some SPY calls, maybe some QQQ calls, even TQQQ leaps, which is the triple leveraged QQQ. And I might buy some leaps in that. Also, I might buy some small cap growth stocks, or get into some small cap growth ETFs. Okay, so that's how we're going to play the mini bull market that we're going to see. It's going to take about another month or 2, I think, to bottom out for the market, the overall market. All right. I think it's going to take some time for it to bottom out. I don't think this is going to be a V. Again, just, we've talked about this before, the TINA concept. There is no alternative, but there are alternatives now. Okay. Last year, the year before, there were no alternatives. Now there is. Dollar's on an upward trend. So holding dollar cash is an alternative. Treasury yields are now at respectable levels. They're still at negative real rates, but they're still, around three, high twos, low threes. So that is now an alternative. So we're not going to see those big V moves anymore. I do think the bottoming process, though, it's going to take about another month or two. And in that month or two, we may even see newer lows, especially if we see deep cuts in guidances. Okay. And again, I won't know that for sure for another 2 or 3 weeks, but it's very possible that these value lines may actually have to come down. All right. If earnings growth is, if earnings estimates are getting cut way more than 5%, then I think it justifies us moving these lines a little bit lower. Okay. But again, that's 2 or 3 weeks away from confirmation. So we'll see. Okay. And so then if we have to change our valuation, I'm sure a lot of institutions will also do the same. They'll move their valuation lines. And so we may see more of the bids getting brought down a little bit. So in this low liquidity market, I can definitely see us getting, dropping down to those bid levels wherever they are. Right now, though, I think the bid is still around here in the 360 zone. I still think, based on the assumptions today, most of the institutions find this to be the value level. But again, after this ER, we'll see. Okay, we'll see. All right. So the plan still hasn't changed in SPY yet. Okay, the plan still hasn't changed. But again, I think RTY. Small caps may be a stronger index now after this June rebalance. And again, this is telling us that growth will outperform value if we see a rally. Okay, so that's what I'm looking for. 10 and 2, bank profitability, still negative, still inverted. All right, let's look at the 30 and 10. 30 and 10. Dropping. That's not good. You want to see this going up. Actually, if you wanted to see a sustained rally, you want to see this at like 0.4 or above. You wanted to see this like shoot above, break out over 4, retest it, and go up. But that's not what we're getting now. Now we're getting, if it continues down and gets inverted and stays there for a while, we could see a very volatile summer. Okay? So watch out for this too. It seems like we got a lot to look at. But anyway, this is the commodities risk on, risk off signal. Store of value versus industrial metals. Still, gold outperforming copper. So commodities market is giving us that risk off signal still. Okay. One thing I noticed today that I just wanted to point out too, that a lot the U.S. dollar, we know that it's on a rampage, but it is definitely outperforming against the emerging market currencies. We see much bigger changes, especially compared to like the South African rand, the Turkish lira. Mexican peso, all of these, huge, steep losses in the last few sessions. The U.S. dollar really making a lot of gains against these emerging market currencies. And again, I told you guys a good way to track that is the CEW ETF. The CEW ETF has been just declining, not really giving up and retracing any of its losses. And again, that's what's giving me the confidence to stay in my EEM puts. Okay, I'm staying in these EEM puts. I still think there's more to go in this. We may see, I don't know, maybe a relief rally or something like that, but still with the strength of the dollar, as the dollar stays that strong, every day it stays that strong, it just increases the likelihood of an EM, a debt crisis contagion. All right. Already in Sri Lanka, the president ran away from the country, and they're already looking for a new leader. Okay, they're already now there's already contenders to fill in that spot. They got, Sri Lanka has 30 days in their constitution to pick a new leader. So already you're seeing mass riots in certain countries. Pakistan will follow. They will have energy rationing pretty soon. Countries like actually in the eurozone today, if you noticed, a lot of eurozone stocks were selling off. FEZ is the eurozone ETF. Okay, down. It was down much more today, and a lot of that actually came from your less economically productive countries like Italy and Spain. All right, your more productive countries are like countries like Germany, but some of these bank stocks in Italy were falling 5-6% today. All right, so Italy definitely not in a good spot. Neither is Spain. They unfortunately, these are countries that are not as productive as Germany, but they share the same currency as a country as productive as Germany. So that's going to be a very interesting problem for the ECB. Okay, I just think there's going to be way more pain ahead for these countries, especially for Spain, Italy, Greece. Let me see what Greece is. Yeah. So, surprisingly, Greece is not doing as bad as the rest of Europe. But that just maybe is because it just has fallen so much. But there's way more to fall though, in my opinion. So we shall see. So we're already seeing lots of problems in many different countries. I think China's next. Okay, I really do. They're talking about reopening and such, but already right now, they're having issues. Construction companies are not finishing their construction work. There's construction companies that are basically failing in between projects. They start a project, they take on all these jobs. They get customers who want to build houses. They get commitments from all these new home buyers, and then they're just not finishing the job. They're failing before they can finish, and so a lot of these Chinese new home buyers, they're refusing to pay the mortgage while the project is unfinished. Okay, we are now getting to that point in China. All right, again. Just the data, okay? The media loves to spread stories. Remember here when they said, "Oh, Shanghai is opening, good news in China," and we called BS on that. Remember, I said Australian dollar is calling BS, copper is calling BS. Remember that? Remember that data point? Australian dollar is such a beautiful lie detector for China. Okay, and it's still on a downtrend. It's still in its downward channel. All right, so I'm still very confident in my puts. Now, I did make a change to my puts. Most of my puts are the here. Let me just show you guys. Most of my puts are in the November spreads. The 31.26, and there's a healthy bit of profit in there. More to come. I still think there's more meat on those bones, but I rolled my August puts into September. Okay, if you guys remember, I was in those August 31 puts. I rolled it into the September 30s, and I got like a few cents credit for it. Basically, for nothing. I think it was like 5 cents, 5 or 6 cents of credit per spread. So okay, I'll take it. But again, that's very small, like extremely small, even compared to this. All right. I wish I had legged in more. Again, I'm like 93-94% cash still, but I wish I had more of these. But even out of a small position, the non-spread puts are like not even 20% of the full value of this whole position. So I just rolled it because I just didn't want to worry about it too much. If there's like a relief pause in the dollar or something like that, and it causes Chinese markets to go up a little bit overnight, I just didn't want to have to worry about it. So I just rolled it, gave myself another 30 days, lowered my delta just slightly. Okay. All right. So there's that change. Still in my EEM, just for your peace of mind. I'm still in. Okay, still in. And I'm still in my UVXY. All right. Still in my UVXY as well. December's still 15-20 call spreads, long the 15, short the 20. Almost in the 14-24s, long the 14, short the 24 calls for UVXY. All right. Oh, and I forgot to mention this in the other videos. I'm still in my Dow lottos. Again, this is super small. I bought only 10 of these at the time. So that's what, like $750? That's nothing. $750 is like such a, like not even, it's such a small percentage. It's just almost nothing. I'm not even counting it as a position anymore, but I still have it. I still got a year. But yeah, but those are the main positions I'm in is FXI, EEM, and the UVXY. Okay. And again, I still have the same plan. The SPY plan, I already went over it earlier today. With oil, I still... this is very depressing. Man, why couldn't it come here? God damn, that would have been nice. Oh, well, we don't always get what we want. But if the dollar drops and it happens to get up to here, yeah, you can bet I'm going to start shorting. I'll leg in here, but most of the puts I'll buy will be here at 120, okay? Same thing with corn. Again, very depressing. Never got to this. I should have just gotten aggressive here. I thought about it and I was like, no, what if it goes against me overnight? I should have been aggressive. But then, Murphy's Law, right? When you're patient, the market wants to move, but then, when you get aggressive, then the market wants to take its sweet ass time. So, it is what it is. This market is kind of tricky like that. Okay, so what else are we looking at today? We should look at Bitcoin as well. Now we're seeing a little bit of a divergence. I just wanted to go over this as well too. We're seeing a little bit of divergence between Bitcoin and the rest of the risk asset market here in the United States. It was tracking the NASDAQ and small caps very well, but now we're seeing a little bit of divergence. Why is that? Well, I think it's because of the monster options expiration that we're seeing in Bitcoin. Okay, we had a huge we had a huge weekly expiration. We're in the middle of a huge monthly expiration now in Bitcoin, and also too now we're starting to see a lot more volume in the August contract. Before we head to Bitcoin, actually, before I forget, I also wanted to show you guys just the as this is a monthly options expiration week for the S&P 500. So I just wanted to show you the SPX, the S&P 500 cash index, and what it looks like. Guys, don't be surprised if we see pumps today and into tomorrow. Why? We got so much in the money puts, so many. I mean, look at this, 3,800, 28,000 puts. Yeah, and again, just to we keep things in perspective, the nominal value of an SPX option is 10 times higher, 10 times more than a SPY option, SPY option. So it's like as if nominal value, it's like 298,000 puts in the money, okay, at 380 or so, okay? Again, SPX options are about 10 times more expensive than SPY. So 29,000, 23,000 for 3,850, 3,900, also 24,000. I mean, yeah, so we got lots of in the money puts. So don't be surprised to see little pumps throughout the day into tomorrow, okay? I think it's going to be a lot of options positioning. Actually, what I see is probably that these hedges are probably going to stay. They're probably going to get rolled. They're probably going to get rolled out into something lower delta, and so and something that's further dated out, probably September, maybe even December. We'll see later today when the open interest updates in stocks and in indexes. The open interest updates only once a day at around 2 a.m. Chicago time. So I'll monitor it then and see if where the options, the open interest changes the most in the September and December contracts. But I think that a lot of institutions, there's still a lot of unknowns out there, especially with the Fed meeting. We got a big one in July, and then we got another big one in September coming up. So I can see lots of people within the money puts, lots of traders rolling these out into further dated contracts that are lower delta. So since these institutions are rolling into lower delta, they're partially cashing in some of those puts. What does that mean? The market maker is going to reduce their negative delta. Okay. Well, no, actually, no, because institutions are lowering their negative delta by rolling into lower delta puts, the market maker is going to take on they're going to take on that negative delta. So what does that mean? They have to long some of that underlying. Okay, so when institutions roll their puts that are negative delta, they roll it into puts that are less negative delta, further out the money and further out in time. It's like as if the market maker has to take on a more bullish position. So because of that, they have to take a more bearish position. So because of that, the market maker will have to long some of that underlying. So again, that's the reason why you're going to see some pumps throughout the day as these roll out. Okay, so just keep that in mind. We might see those pumps. Okay, somebody was asking me that earlier today. Why are we pumping today? Why is the market even pumping in the middle of the day? Well, it's options expiration, and it's pretty big. September is even bigger. The September S&P 500 options expiration is crazy right now, and so is December. Those are going to be really crazy months. Okay, I can already see it. All right. Okay, back to Bitcoin. So we talked about options positioning in S&P 500. Let's talk about that in Bitcoin now. Lots of puts. I mean, that's the story of Bitcoin for the past 24 hours. Lots of puts getting bought. Lots of puts. Okay, where are those puts being bought? A lot of them are actually now being bought for August. We're actually seeing August and September getting the big block buys. Okay, a lot of the big block buys are happening in August and September. A lot of the put buying still is coming from regular screen trades or smaller trades. So, most likely retail. Retail, though, is still buying puts on the end of the month. Okay, so retail is buying puts for the end of the month. Institution block traders are buying puts now for August and September. Okay, and we're seeing also the volatility increasing with those puts being bought. All right. So let's take a look at some of that. So it's here. See that? Puts dominating. Puts really dominating the trade for the last day or so. All right. Skew still looks about the same. Yeah, skew still looks about the same, but now we got August. The August is now starting to get that backward skew toward that put side, toward those lower strikes. All right, and so again, retail is they still seem to be buying these July 29th puts. There's still a significant amount of hedging going on for July 29th. Okay, still a significant amount. I mean, look at these OIs. I mean, 18,000, 17,000, all the way down. Still lots of volume in there. Okay. Actually, I just noticed that there was a call right here. That wasn't there when I first started the video. It was all puts right before I started the video. So something must have happened on July 15th calls. Speculators coming in, short-term speculators, or maybe call sellers are covering. Could be. I mean, we saw a little bit of a pump today, so maybe that's what this is. What strikes were they for? Yeah, you're seeing. I'm just seeing this for the first time too. It just happened literally as I started the video. So 20,000. Okay, that could be some speculation right there. All right, just people speculating for today and tomorrow. Possible, very possible. It is options expiration in S&P 500, so maybe they're thinking that maybe it'll carry that a correlation. Again, I think the reason why the correlations are different now, and we're seeing that little divergence, is because of all this massive options action that we're seeing. Okay, I think that options are getting rolled from July to August. So again, what did I say about in the S&P 500? If institutions are holding puts, they are long on puts, if they're rolling it further out the money and further dated, and those are lower delta, that means that means basically that the institutions are lowering their bearish positioning, their bearish hedging. So that means the market maker is increasing its bearishness. So therefore they need to buy some more of the underlying to even out their bets. And that rolling mechanism, I think, is causing Bitcoin to come up, even though the rest of risk assets like equities are coming down. So I think it's because of the options rolling. It's just the sheer amount of rolling that's happening into August, I think, is sending Bitcoin up. I think that's what it is. It's all because of that rolling mechanism. All right. If you don't understand what that means, we will go over that in more detail in our educational courses that we come out with at the end of the year. We'll go over how dynamic hedging and how market maker positioning can affect the markets. Okay, but it's the same mechanism as we've talked about before. Okay, if the market maker has to take on more bullish positions, they'll have to even it out with a bearish position. If the market maker takes on a lot of bearish flow, well, again, they're going to have to get bullish on the underlying to even out their order books, okay, or their books, to remain delta neutral. Okay, but we're seeing lots of hedging happening here, lots of volume, especially in the lower strikes. 14,000. We're also seeing 20,000 on down. That was August. Also September too. The quarterlies also seeing some increased participation now. So people, I think the block traders, they're rolling into the 26th. The August contract and the September contract. We're not seeing them roll all the way out to December yet, okay? Although I think they've already built up some positions in December. Yeah, look at these OIs. Look at that. That's just huge. They've already been building this up. So now they're building up a little bit more towards September and August. So maybe they see something happening. Maybe that's when they see the pivot. Or maybe they think that, the Fed will pivot around September. That's what I think. And I've been saying that now for a few weeks now, that I think the Fed is going to pivot probably around September, October, right as the CPI starts cooling down. I think this CPI or the next one is going to be the high one for the season, and then it's going to start cooling off for the next 6 months to a year or so. We shall see. That's what the bond market is saying, and maybe that's where the Bitcoin market is taking their cue. They're looking at the bond market, they're looking at that positioning, and they're now repositioning based on how the bond market repositioned. That's crazy. It's all a connected system. It's phenomenal what a force of nature markets are. It really is a natural phenomena. It is a force of nature. It really is. There's a balance and there's an equilibrium. And when one thing shifts, other things have to shift too. Very much like the cosmos, or very much like how energy or particles also shift around based on energy levels. I know it's getting nerdy and sciencey, but there is a reason, I think, for this, and there's a reason why people study this stuff. I just find that very amazing, truly amazing. Okay. So again, recap. Okay, recap for the day. This is why Bitcoin is diverging. I think there's a lot of options activity. It's forming its own options activity. It's now having its own options activity outside of tracking, some stock index. I think the crypto market is taking their cue off the bond market. And again, if you are looking at risk assets, okay, and you want to gauge that risk on, risk off sentiment, all right, the number one thing you really got to look at for this season, again, is Euro USD, okay? If this starts coming up, I think that's very bullish for risk assets. And that's why you're also going to be monitoring the dollar as well. If the dollar comes down, I think that's going to be very bullish for anything that's priced in dollars. And also, in order to get that, I think in order for that to happen, though, I think you need to see shorter term rates come down. So you need to see a bid in these shorter dated notes. Okay, those are, so 5-year U.S. Treasury note futures, that's /ZF, all right, Euro USD, all right, and the dollar. Those are the ones that you can track. And then also the junk bonds advance and decline line that I post every night, okay? Those are the 4 things you're going to be looking at for risk on, risk off for any risk asset, stocks, crypto, anything, okay? That's going to be the tell, all right? And again, just our positions. Just let's run through it one more time. UVXY still in those call spreads. FXI still in those put spreads for November. I rolled my August puts into September puts. All right. And EEM still in them puts for March. All right. The plan hasn't changed. I'm still going to acquire shares at 342. If it goes below 340, I'm going to start buying in the money calls that are 12 months out. 2 or 3 weeks later, if I notice that the guidances are much lower, or earnings guidances are lower, more than more than 5%, I'm going to start shifting these lines down. But until then, that's the plan, okay? Still, the plan for crude oil, if it gets there, if it gets here, 120, 111, and 120, we scale in at 111 for put spreads. But most of the put spreads, I'm going to wait until 120 if we get there, all right? Same thing with corn, if we get there, all right? If we get to 720, actually, I may even start scaling it at around 660 if it happens within the next couple of weeks, all right? And wait for the big ones at 720, all right? And also, too, let's add this to the plan, Euro stocks. If European stocks have a relief rally and get up to like 30, 37 or so, 36, 37, I'm going to start scaling into some puts. But it's got to happen quickly. It can't be like it happens like in September or October. No, it's got to happen like soon, like in the next few weeks. Okay, in the next 3 weeks. In the next 3 weeks, if this can have a relief rally to 36, 37, I'm going to start buying put spreads 3 to 6 months out on the European stock index, FEZ. Okay, so those are the current positions. That's the current plan. That's what's to look for. Boom, right there, guys. High noon highlights. Any questions? Comments, rude remarks? Going once. Going twice. Sold. Okay, all right, guys. I'm going to log off and stop the stream right here. If you guys are joining us on YouTube or Twitch, we do have a Discord. Join the conversation. We've got a lot of talented traders here with different styles. We bounce ideas off of each other. As always, I'll keep our Twitch stream on so that you can see the charts and the data that I'm looking at throughout the day. I'll stick around in the Discord. I'll answer any questions, and we'll go from there, okay? I'll try to be back on later on today, but if not, I'll try to make some time tomorrow. Hopefully, end of day tomorrow, we'll go over some weekly charts as well. Okay, guys? Stay safe, and I'll see you.